Welcome to Yahoo Finance Live. I'm Julie Hyman with Josh Lipton here at the New York Stock Exchange. Here's what you need to know as of 3 p.m. Eastern, that is right now. President Biden speaking moments ago, blasting the Hamas attack on Israel. He said the U.S. stands with Israel and will make sure the country has what it needs to defend itself.
And the bond market first reacting to the war in the Middle East, but also more dovish commentary from Fed officials. Atlanta's Bostic says rates are high enough to get inflation down at 2%. Interest rate traders pricing in a 12% probability of a hike. That is down from a 28% a week ago.
And the trial of Sam Bankman-Fried heating up. His ex-girlfriend and former Alameda Research CEO Caroline Ellison taking the stand. We're going to break down her testimony with someone who was in the courtroom. But in the meantime, let's get a check on markets here as we are closing in on the closing bell. An hour from now, we've got all three major averages in the green, down off the highs of the session, though. The Dow gaining about 0.4%, the S&P up about 0.6. We are seeing a comeback in consumer staples stocks being led by Pepsi, helping matters there, and Nasdaq as well, trading higher by about 0.2%. We are also watching a big move in the Treasury market today. And unlike in recent days, it's a move to the downside in yields, upside in prices. Take a look at the 10-year down 15 basis points today, 4.65%. The 30-year backing well off that 5% level, down 14 basis points today, Josh.
Yeah, and so let's start with those treasuries, because you do have that rally in treasuries today, some yield relief, and so that leads to some green on the screen for equities. Some interesting reasons for that. I mean, maybe, Julie, given the war in the Middle East, the conflict there, some folks are looking for safe haven plays, but probably I think it really comes down to these central bankers, right? And the language, the rhetoric we're hearing out of these policymakers saying, listen, you know what, maybe these surging yields are doing the job of the Fed for them in terms of cooling the economy, and that, of course, is giving some optimism to some folks who are thinking, okay, maybe that really is the end of this rate hiking campaign. Interesting article here from Nick Timmerhouse in the Journal, and when Nick tends to write, people tend to pay attention. He says a sustained rise in long-term Treasury yields could be bringing the Federal Reserve's historic rate hiking cycle to an anticlimactic end.
Yeah, I mean, and that's something we're hearing from Fed officials as well. We mentioned Atlanta Fed's Raphael Bostic giving a speech today and saying the Fed might not need to raise borrowing costs further at all. That's echoing some recent commentary we've gotten from other Fed officials as well. We heard from Lori Logan. We heard from Philip Jefferson yesterday, and sort of making comments in the same vein. All of this has really changed the prospects that the market is pricing in an interest rate increase at this meeting in November. If you look at the CME Fed Watch tool, which prices in those interest rate futures, we're looking, this is the change that we've been seeing. Right now, we're around 13% or so, 13, 14%. Yesterday was around the same, but a week ago was 28%. A month ago was 44%. Yeah. So we really have seen a big change. Part of that, as you said, is because of the higher interest rates, sort of doing the Fed's job for it.
Yeah, you watch that benchmark 10-year, right? And the way it's surging, of course, that's that key borrowing cost. It's helped setting the price of everything from auto loans to mortgages to business debt. You know, if they do, though, take this pause, of course, November 1st, you wouldn't see Jerome Powell come out and wave a victory flag, because I think they've been as kind of surprised as everybody else about how resilient the economy is. So you expect him, maybe he holds Julie, but then leaves open some room here for more rate hikes if and when they see them, maybe in December.
Yeah, I think that's a reasonable expectation.
Okay. Well, moving on. President Biden is voicing his support for Israel in his remarks on the Israel-Hamas war. Take a listen.
Let there be no doubt. The United States has Israel's back. We will make sure the Jewish and democratic state of Israel can defend itself today, tomorrow, as we always have. It's as simple as that. These atrocities have been sickening.
The president's support comes as Israeli officials warn of a long war against the Hamas militant group after Hamas fighters launched a surprise attack on Israel, prompting an all-out war between the two sides. Now, here to discuss all the latest is CFR Senior Fellow Stephen Cook. So, Stephen, let me get your take, first of all, on these comments from the president. And I'm broadly interested, Stephen, what do you make of the Biden administration, how they are navigating this crisis so far? I realize it's new. It's a very fluid, dynamic situation, but I'm interested to get your take on their performance so far.
Well, there's nothing surprising about President Biden's statement. He has long been a very strong supporter of the state of Israel, and he is the one who is driving this policy. He's someone who brags, and in fact bragged in his remarks, that he has known every Israeli prime minister since Golda Meir in the early 1970s. So the declaration that the United States would stand shoulder to shoulder with Israel, the declaration that the United States would provide Israel with whatever it needs, the deployment of an aircraft carrier battle group into the Eastern Mediterranean, all of those things were either telescoped earlier by the administration or something that no one watching this or knowing anything about President Biden would be terribly surprised by.
Stephen, what does Israel need at this point?
Well, I think the greatest need for the Israelis is these Iron Dome interceptors. Iron Dome is a system that the Israelis developed and deployed, and then an American defense company, Raytheon, became a partner to the Iron Dome program. The interceptors that intercept the Hamas rockets are very expensive, and Hamas has fired thousands of rockets at Israel so far, so they're going to need them, especially since there is a threat of rocket fire from the north as well. Hezbollah, the terrorist organization that is a proxy for Iran, is known to possess in excess of 100,000 rockets that could reach any part of Israel. So as this war grinds on, the Israelis are going to need the United States to help them resupply those interceptors for Iron Dome.
And Stephen, you mentioned Hezbollah to the north, a threat there. How much of a risk do you think is there that this war does extend to multiple fronts?
Well, that's clear that President Biden is trying to head that off, not only with the deployment of force and the declaration that the United States' commitment to Israel is ironclad. There is some diplomacy that is going on. The United Arab Emirates, which has relations with Iran, is communicating to the Iranians that they should not seek to widen the war by activating Hezbollah against Israel in the north. Thus far, there has been some fighting in the north, but nothing along the lines of that causes a tremendous amount of concern of a wider two-front war.
Stephen, how is misinformation playing into this war? There have been a lot of complaints about the information on social media, on X in particular, formerly known as Twitter. And this is a war that has, and a conflict that historically has a lot of propaganda coming from both sides. How can that maybe feed back into the conflict here? What are the risks?
Well, anybody who's looking for credible information about the war and what is happening should probably stay off of X. But you're quite right. Misinformation and propaganda is a big part of all of the sides, and the horrifying images that have come out of both Israel as well as the Gaza Strip in recent days certainly serves to inflame global public opinion. So it's hard not to. It is hard for those who are interested in this not to be affected by those photos, but also to be. They should be very, very careful about what they are looking at when they are doom scrolling, which I don't suggest that they do.
And Stephen, in the past, the U.S. has given the Israelis room to work in whatever way they see fit. And I think we sort of heard Biden administration saying that again right now. But, we've seen that before, Stephen. The U.S. administration will give the Israelis room and then quickly pulls them back. Do you think that could happen again this time? And if they did, do you think Netanyahu would listen?
Well, I think that President Biden, by dint of his remarks and by the number of Israeli casualties and those killed so far, is going to give the Israelis really a very significant amount of leeway here, more so than we have seen from the past from any recent president. So, but you're quite right. There will come a point where you will see these images of killed Palestinian civilians, women and children, the destruction that the Israelis are going to bring down on the Gaza Strip. And there will be pressure from the Europeans, from Arab partners, and then ultimately from voices within the United States to try to restrain the Israelis. I think what's also different this time is that the Israeli public is foursquare behind the government that has declared a strategic goal, the destruction of Hamas and its military capabilities. That will probably give the Israeli government, which is likely to change in a couple of days, it's likely to be, in the next couple of days, likely to be a national unity government, that will give the government some political buoyancy to resist calls from Europe, Arab capitals, and then ultimately perhaps the United States. But I think that Israelis have much longer room to run here than they had, for example, in May 2021, where after 11 days they brought it to an end. This is going to be a very significant combined arms Israeli operation that is intended to fundamentally alter the rules of the game by taking Hamas out of the game.
So what does success look like for the Israelis, Steve? And then what happens?
That's the real difficult question. Success, as they have defined it, is the destruction of Hamas and its military capabilities. But the Israelis may find themselves reoccupying the Gaza Strip or parts of the Gaza Strip for periods of time. This is territory that the Israelis have been actually trying to give away. In 1994, they gave it away to their arch enemy, Yasser Arafat. Since then, they have from time to time signaled that they'd like Egypt to take responsibility for it. No one actually really wants it. And so there is a very significant problem for the Israelis that reoccupying the Gaza Strip could be a trap and may, in fact, be part of Hamas's strategic goals here, which is to draw the Israelis in to a long, grinding conflict that will weaken it.
Stephen, really helpful perspective on all of this. Stephen Cook of CFR, thank you.
Thanks, my pleasure.
Well, all of what we're talking about has profound implications for the oil market as well, which has been watching every move out of the Middle East. Crude edging lower on the day, but any risk of escalation across the region could have repercussions for that oil market. Joining us now, Ed Morse, Global Head of Commodities for Citi Research. Ed, up until now, we have not seen any concrete sort of spillover that would actually spell a real supply-demand change in the region. But what are you watching as potential areas that could signal that could change?
Sure. So one of the things that we've been watching is, of course, Saudi Arabia. They were a week ago, not quite a week ago, even on the verge of an agreement that was about to be announced involving the recognition of Israel, involving putting more oil in the market, involving some nuclear cooperation with the United States. And all of that is on hold. So we're going to see a prolongation in all likelihood of the Saudi-Russian oil cuts that have really pushed oil prices up well beyond the level that they otherwise might be. We know that a lot of blame is going to Iran. You just spoke a few minutes ago about, along with Stephen Cook, about pressure that the UAE is putting on Iran not to escalate things. Iran looks like it's behind Hamas, looks like it's behind Hezbollah. I suspect that means that the U.S. is going to be tightening up on the freedom of Iran to put more oil in the market, tightening up on sanctions. We don't know where that would go. But in the meantime, the oil market has been, pretty immune to what's been going on. And we've seen that in the jump in prices, which was not as high as people expected it would be, and prices have begun to come off. So the market is jittery, but there's been no effective change in the balances to date. It's all what ifs might happen.
Ed, though, is what you're describing, particularly with now that lack of Saudi agreement, does that at least make a more solid floor for oil prices if there is no kind of short to medium term possibility that Saudi would back up on that production cut?
Well, it's a dynamic process, and we've thought through the summer that we're going to see significant increases in supply from around the world over the fourth quarter, and we're going to see great challenges on the demand side, given the state of the three largest economies in the world, with Europe in recession, China struggling to get growth going, and the U.S. Moving in a direction of lower growth, if not into a recession. So we're looking at a relatively weak demand environment with potentially huge strength coming out of non-OPEC countries in particular, another 500,000 barrel a day growth out of the United States, big growth out of Brazil, out of Canada, out of the non-OPEC world. And we think we're going to have all else equals, an inventory build rather than a draw in the fourth quarter, which would weaken markets. And we think the markets will be even weaker next year. So part of the dynamic is, the prices have come up because of summer demand in part and withdrawal of inventories. But we're now seeing a switch in the dynamics of the market, a move to a more bearish environment. And it's in that context that we have to try to assess whether there are going to be more disruptions in the market itself.
In terms of those disruptions, though, Ed, right now it seems like the market thinks of this war in the Middle East, this war between Israel and Hamas, as contained, as limited. But what if Israel does attack Iran? If Israel attacks Iranian assets and infrastructure, obviously that's hard to map, Ed, but what are the kinds of scenarios investors would have to think about and what that would mean for the oil markets?
Well, we certainly can think that Iran is not going to sit by idly if attacked by Israel, and particularly if their nuclear facilities are attacked. They're likely to go after assets around the Middle East that are vulnerable, depending on certainly, where American assets are. This could be, a tit for tat, similar to what happened in the fall of 2019 when they had drone attacks that hit Saudi Arabian oil supply. The good news is for the market that with the cuts that have been taken, we have a good 4.5 to 5 million barrels a day of spare capacity in the world. We have significant growth still coming out of the United States and a number of non-OPEC countries. And should prices get significantly higher, and by that I mean above 100, I think we can expect that the spare capacity that has been held back, particularly by Saudi Arabia, the UAE, and Kuwait, will come finding a place in the market because they have no interest in having an even greater slowdown. And they've indicated this in articles in the Arabian press. So we think there is a cap. The cap is not 130 or 150. We think it really is in effect around 100, which would be a lot lower than we had through much of last year. But if there is no tit for tat after an attack on Iran, then the market itself should be considerably looser. So yes, a lot happens if Iran is hit by nuclear on its nuclear sites, and then we don't really know where things could go after that.
Ed, understanding that you're a commodities guy, not a geopol guy, although there's has to be a little bit of crossover. I mean, how do you assign a probability to an event like that, to an escalation of the conflict and something happening between Israel and Iran?
All I can say is that we have to take into account what we read and what other people say, and certainly the pinpointing of the relationship between Iran and these enemies of Israel lead to a thought process that goes in that direction. Putting a probability on it is a very hard thing to do. We've not had any direct attack on Iranian facilities. We've had an undermining of them through subterfuge, but no direct attack. So it's harder to put a probability on something that's not happened. It's not hard to think of the damage that could be done if something like that does happen. We're in a period of incredible geopolitical uncertainty. It's hitting natural gas markets as much as oil markets. We've seen it on the natural gas side with Israel shutting down its offshore gas platform that was sending a not insignificant amount of natural gas into Egypt and from Egypt into Europe. So we've seen, an increase in prices of natural gas, partly as a result of that. So it is an area where there are supply chains that are at stake, and we don't know what's going to happen to those supply chains.
Ed Morse, thank you for your time today.
Thanks for having me.
And time now to take a look at some of today's trending tickers. Shares of Block jump as Bank of America reiterates its buy rating on that stock. Bank of America citing Block's currently cheap valuation and strong fundamentals as catalysts for potential upside here. So this stock, Julie, has not worked at all. It's been a mess. It's down about 30% so far this year. Of course, that's what Bank of America is saying. That's overdone.
Right.
It's too much. The pullback is overstated. They say, so they move to a buy. They say this is part of a broader pullback, a rotation out of growth stocks. By the way, not surprising they have a bullish call. I was impressed by the fact, look at the street, nearly 75% of folks do have a buy on this one.
Yeah, I mean, just to be clear, they're just maintaining their buy. They're not initiating their buy. Their price target on this is $71. And also, I guess, just to be fair, I'm wondering how long they've had this buy rating. Like, have they had the buy rating while the stock has continued to go down, as you pointed out, 33% this year? I don't know what the history of the call is, but nonetheless, you know, you have to ask those kinds of questions. As you say, they're pointed to the decline this year being unjustified, that there's investor positioning that's pushed it down, that there's questions surrounding execution on Square and kind of how the company's structured, Cash App deceleration in the third quarter. Like, none of those things sound great, but Bank of America still thinks that that there is upside.
Yeah, or that with that kind of
EBITDA.
move, that a lot of that's just priced in.
Right, I guess so. But still, $71 is pretty far above where it is at these levels. By the way, the company is set to report in early November, so we'll get more
We'll be waiting for it.
details on that. We also, hopefully, will get confirmation and more details at some point on this next story. Shares of Truist Financial getting a lift as it is reportedly in talks to sell its insurance business for $10 billion to Stone Point. This is according to reporting from Semaphore, which says a deal may hinge on Stone Point's ability to scrounge up enough debt, that's a quote, in a market that has been skittish on buyout loans. Now, Stone Point actually owns part of this business already. It bought it earlier this year, about a 20% stake. At least they led a group that bought a 20% stake in this insurance company. So this would be selling, sounds like the rest of it or the bulk of the rest of it to Stone Point.
And investors, I mean, look at that pop. Investors like they would see. I will say there's some analysts like Jefferies. Now they're a hold on this name, so they're on the sideline because they kind of see a tale of two tapes here. They say yes, it should benefit capital, maybe add earnings per share (EPS). But on the other hand, they say this would make Truist a less fee diverse bank. So they remain on the sidelines.
Yeah, Mike Mayo, closely watched financials analyst at Wells Fargo, saying that the deal here could show management is willing to take more forceful moves for a revamped Truist 2.0. Very colorful Mayo commentary as usual.
Mike's good with the headlines.
Yeah.
Rivian, of course we're talking about Rivian. I think every day I think is a Rivian.
feels
day. Yeah, I
like
think so.
it.
Rivian shares popping after UBS upgrades the stock to buy from neutral. So there's a new fan on the street. This coming a day after Wedbush points to Rivian's street credibility taking another hit, although Wedbush did remain a buy on it. So they upgrade the EV maker to buy. They talking about an improved setup following that recent capital raise. I remember we talked about that. They announced that, the stock crater, nasty sell-off. And now, but UBS is saying, okay, post that rough headline and reaction, investors can refocus on what they're seeing are better fundamentals.
Yeah, UBS says they probably don't need more capital to the end of 2025, but I am reminded once again of what Dan Ives of Wedbush wrote about Rivian yesterday, which was effectively, this is the last time, Rivian.
Yeah,
You did the capital raise, you did the convertible offering.
Yeah.
We put up with it, but not again.
Yeah, you maintain that buy or outperform, but that was a rough maintaining.
It was, yes, it was a bearish outperform.
Yeah, well, I think you said it was kind of like parents, a little slap on the wrist.
Yes,
like,
exactly. This is the last time. So if UBS is right, it'll be the last time until 2025.
And by the way, when you say that, I almost ate a little startled. I think I'm like taken back like 1985 Josh Lipton for a second. Yeah, good. Yeah.
That's how it should
That's how
be.
it works here.
All right, we're just getting started here on Yahoo Finance Live. Coming up, we are getting you ready for earnings season. Yep, it's around the corner. Next hour, we'll have everything you need to know about when the big banks in particular start reporting on Friday. And EVs, the road ahead. We'll talk about the different ways you can invest in the electric vehicle industry. And guess what? It's not just about Tesla or Rivian, for that matter, that we were just talking about. Also, it's Amazon Prime Day. Again, we're going to break down the state of the consumer ahead of the holiday season. All that and more when Yahoo Finance comes back. After a consecutive monthly decline, stocks are starting off October on an up note. Jared Blickery's on the floor of the New York Stock Exchange right behind us with a closer look at what we are seeing thus far. Hey, Jared.
Hey, Julie, let's look at the Wi-Fi Interactive. We are only 7 trading days into October, but guess who's in the forefront? XLC, that is communication services, one of those mega cap sectors that we know very well. And number 2 is tech. And if you'll recall, those were the most represented sectors in the lead up in the first 7 months of this year through July. Lots of stories about mega caps being kind of crowding out the other environments, or that the indices are overweighted. Nevertheless, that relationship has reasserted. However, I'd also note that healthcare is also an outperformer. That is up 1.8%. Now, when we take a look at the decliners here, it's all defensive. Utilities, energy, and staples. And yes, energy historically more of a defensive sector that can be argued, but staples definitely defensive. Utilities definitely defensive. And this is kind of what you'd expect with higher interest rates, but not necessarily, and I'm talking about utilities here, but not necessarily those long duration growth stocks. So we'll have to see what comes of yields, but with the big drop off today in yields down about, 11 basis points, that does provide a little bit of a tailwind for stocks. Now, let me show you something else which is about to provide a tailwind, and that is seasonality. This is the VIX in cyan versus what it usually does, and this goes all the way back to 1990, so it's a blended average. And then the purple line is what has happened this year. You'll notice that we are right up against, and I've shown this for several weeks, right up against a potential peak that we usually see on October 12th. We did get a rise and maybe a little bit of an early peak there. Hard to say. I would point out that Thursday, October 12th, that due date is CPI date, so we could still see some volatility there. But if stocks and the VIX were to perform as they do historically, we would expect to see the VIX fall and stocks rise into the end of the year. Lots of people noting that seasonality has worked very well this year. I have some alternate calculations of how to calculate seasonality. I am expecting personally that rally into the end of the year, but October could see a little bit of a little diciness first. Let me just take a look. Let me just plot some of these sectors here on a longer term basis. This is tech, XLK. What I'm tracking here is a giant cup and flag. We're familiar with the cup and handle. This is a cup and flag, a very bullish formation, but it's long term. Probably take a couple weeks to see any kind of definitive break to the upside here. But nevertheless, lots of sectors are looking like this. So are the semiconductors, and so a break north of here could potentially see a huge run into the end of the year if seasonality plays out. Always caveat that if is a very strong word here.
Jared Blickery, thank you. And Treasury yields falling today, the move being attributed to both investors seeking security from possible economic fallout from the Israel-Hamas war and, of course, dovish talk from the Fed, officials indicating further rate hikes may not be necessary. Atlanta Fed President Raphael Bostic saying the current policy rate is sufficient to get inflation down to target. For more, we're going to turn now to Dryden Pence, Pence Capital Management CIO. So, Dryden, actually, let me start with the news here. We had President Biden making comments, of course, on the war between Israel and Hamas. I'm just thinking, Dryden, how you're thinking through this new and very real geopolitical risks for investors. How are you thinking through Dryden, and what are you telling your clients?
Well, typically these geopolitical risk situations create maybe a market on average. You go back to the last 23 times, the market has reacted about 4.5% to the negative over a period of 9 to 15 days. And then by 40 days, it's fully recovered. And so I think that as long as this particular circumstance remains contained to Israel and Hamas and does not really go to a broader, more regional conflict, I think we're going to find that the market's going to take it in stride. There'll be a few bumps, but then we'll basically continue on a normal trajectory throughout the rest of the year. These things tend to work themselves out.
Dryden, we have seen some isolated movements over the past couple of days in particular sectors. I think of defense sectors in particular, and those stocks having performed pretty well. I believe that's a group that you like. Do you think that that's going to see a sustained pop? Or, in other words, are there sort of other underlying fundamentals that are attractive to you besides the conflict that is going on?
Well, certainly, we do like defense. When you take a look at the largest company out there, looking at Lockheed Martin, they've got a 2.5-year backlog of their 2023 sales, and you're only going to see continuing utilization of this. Raytheon's a component with Rafael Defense on the Iron Dome. It's about $50,000 every time Israel fires off one of those things. So you're going to see these conflicts, both Ukraine and Israel, are a strong demand for defense, and the U.S. has a very strong defense sector. We have really strong companies there, and again, when you take a look at Lockheed Martin, Northrop Grumman, Raytheon, all of those, they have very large backlogs for their entire sales, and so we think that we're constructive on that group. I don't think that peace is going to spontaneously break out anywhere in the world, and that the demand for defense, and particularly high defense technology, is going to continue. So we think that's got a long bid to it. Also, we do like energy because we think that this conflict and a variety of other things are going to continue to keep oil prices elevated to a level that's going to be accretive and profitable for companies like Exxon and Chevron here in the United States. And I think that for the United States economy, if you say you worry about oil, you worry about oil prices, I think you have to remember, here in the United States, we're the largest producer of oil in the world. While we have a deficit of maybe 5 to 8 million barrels a day, 60% of that deficit is made up from Canada and Mexico. So when you look at this, we can weather this storm in the United States much, much better than the rest of the world can. And this just kinds of tends to make us look at U.S. industrials, things here in this country, that we're able to be kind of less exposed to some of this geopolitical risk. But then wherever there's risk, there's great opportunity. So we like defense, we like energy, and we like things that can tend to benefit from some of this chaos that's going on. But we do believe that as long as this particular circumstance remains contained to Israel-Hamas, then we don't see a wider situation occur that's going to create greater geopolitical risk. We think we kind of roar through this and the market's going to begin to ignore it, because in the end, the U.S. economy is still very strong.
And one catalyst I know, Dryden, folks are looking for, bulls on the market, is, of course, earnings season, and we've kicked that off. I think we can all expect, as usual, 75% of companies will beat, like Pepsi did this morning. What are your expectations for earnings season, Dryden?
We're very positive towards earnings seasons. I think one of the things that people have forgotten here is that CFOs, when you never knew how high interest rates were going to go, you had a hard time estimating margins, and you had a hard time estimating cost of capital. Well, now that we're at the end of the heightening cycle, and we think we are, we actually think that probably, given geopolitical risk, we won't see another hike in November. We'll skip that. And so now people can predict their cost of capital, and they can predict their margins and their earnings. So we think that companies are going to beat. We didn't have the recession that everybody was expecting. Inventories are low. Demand is strong. So we actually are very positive towards the rest of this quarter and into fourth quarter. So we think most companies are going to beat, as they typically do, but even to a greater extent than possible, because the recession that everybody was banking on has not happened, and we don't see it happening this year. So we think that inventories are low, order books people are going to have to normalize these inventories, and so it's going to be a good couple of quarters. We're really kind of focused on, you had the Magnificent Seven, but we're actually kind of more focused on the 493 for the rest of the year.
So in that case, Dryden, and I was going to bring that up with you because those Magnificent Seven obviously have carried things quite a bit this year. Do you buy then the S&P equal weight as sort of a counterbalance to that?
Well, the S&P equal weight is actually down on the year by about 0.9%. You had that, these seven really took the market on, and the rest have not really caught up. So I think that if you think that earnings are, as we do, you think that earnings are going to be pretty good here when we look at third quarter, fourth quarter, you take a look at you could look at the equal weight, because we think that that's going to catch up, or you look at individual companies. We tend to look at individual companies, of course, but you can take a look at these sectors and recognize that, you're going to see some normalization, and we like industrials in this space, and we like infrastructure in this space, and we like things that are driven, here by the local U.S. economy, which is quite strong. So, again, as you're directly to answer your question, we would probably like the equal weight because it's certainly been held down at this point. But I think also you need to look at individual sectors and companies that are going to be able to surprise to the upside as we see this burgeoning industrial growth here in the United States.
Yeah, well, thanks for giving us some ideas of those sectors to look at for investors. Dryden, Pence, thanks so much. Appreciate it.
Absolutely. Thank you for having me.
Thanks. Coming up, more trouble for embattled Chinese real estate giant Country Garden. We're going to break down the troubles amid China's real estate crisis. That's next. More trouble for embattled Chinese real estate giant Country Garden. The company missing a key debt payment, saying in a securities filing that its cash position remains, quote, under significant pressure. Yahoo Finance's Akiko Fujita has been tracking this story. Akiko, sort of along with Evergrande, Country Garden has become emblematic, right, of some of these issues that China is experiencing. So how significant is this latest filing and this latest missed debt payment?
Yeah, well, Julie, the missed debt payment certainly raises additional concerns about the potential for Country Garden to default on its debt altogether when you consider this is a company that already faces roughly $187 billion in liabilities. The company saying in a regulatory filing in Hong Kong, in part, prevailing market conditions have made it difficult for the group to procure, in their words, sufficient cash to enhance its liquidity position. The company goes on to say the group's cash position remains under significant pressure, adding that there have not been any material industry-wide improvements in property sales. As you can imagine, the company's failure to meet this payment has set off alarm bells, largely because Country Garden was considered the one home builder here that was more fiscally responsible. This is a company that state-backed banks were feeling comfortable in lending to because of the perceived stability. Now, on Tuesday, though, we did hear from Country Garden saying property sales fell about 44% in the first 9 months of the year. All of this points to, of course, China's severity in the collapse of its real estate sector. Real estate giant Evergrande, as well as Sunac China, as you know, already defaulting on its debt. On Monday, Evergrande's bond investors warned of an uncontrolled collapse of the group after it scrapped a debt restructuring plan for $35 billion. And guys, we should point out, financial regulators in China have put out a number of measures here to try and reinstill confidence in the sector, largely because of the heavy weight the real estate sector holds in the Chinese economy. We're talking roughly 30% here. A number of measures, including cutting rates for existing mortgages, as well as lowering the minimum down payment for property. But that simply has not attracted buyers back into the market, and certainly not good news when you talk about names like Country Garden.
And Akiko, National Golden Week holiday just wrapping up in China. We know a big driver in consumer spending and real estate deals. What have we learned from this year's numbers?
Yeah, this is an 8-day holiday that is pegged to National Day in China. Traditionally, it is a very lucrative holiday for a lot of retailers in China. The latest numbers we've gotten from government data point to 820 million people traveling around the country, spending more than $100 billion in revenue. Now, that is a huge improvement from last year when you'll recall the strict COVID restrictions were still in place, but it's still well below official projections. And it's just a slight improvement from where 2019 was. Goldman Sachs putting out a note over the weekend saying that these latest numbers point to a deceleration in the services recovery, although it is still recovering. Goldman Sachs going on to say they believe additional easing will be necessary for policy for further recovery in consumption and services. We should also point out here that home sales over Golden Week, certainly something to be closely watched because it is a key time for property developers. When you look across 35 cities, one research firm pointing to a drop in 17% in terms of sales year on year. So certainly not good news on that metric as well.
Akiko Fujita, thank you for that. And coming up, EV adoption. We're going to talk about the different ways to invest in the growing EV space, all that and more after the break.
It has been a winding road in the EV race. Wall Street keeping a close eye on stocks of EV makers like Tesla, as more traditional auto companies expand their offerings as well. As part of Yahoo Finance's week-long special, EVs, the road ahead, we're taking a look beyond the EV makers for where investors can get in on the EV play. Joining us now, Roth Capital Partners Senior Research Analyst Craig Irwin, along with Ron Yevsikow, Guggenheim Securities Automotive Equity Research Analyst. Guys, thank you so much for being here. We always talk about Tesla. I know both of you cover Tesla. Neither of you have buys on Tesla. So I'm going to leave that aside to start us off. And Craig, you cover the much bigger universe of things like charging stations and companies that make different kinds of technologies. So what do you look for in this universe right now to decide whether stocks are worth buying?
Yeah, so we cover, I believe, the broadest universe of EV and charging stocks of all the banks on Wall Street. So when I look for names that I'm going to recommend to my clients, I look for things with discrete drivers where we can have confidence that the trends are friend, right? That momentum's going in the right direction, valuation is fair, and you've got a management team that can execute. And there are unique spots. Let's just say right now, there's a lot of choppiness out there with a lot of things that people want to talk about as headwinds. And there are some discrete, bright spots in the space, and that's what I'm focusing on with investors these days.
Ron, I have a kind of a broader question for you. We've had car dealers come on, Ron, on Yahoo Finance, and they'll say that the demand really is for gas-powered trucks and SUVs, not for electric vehicles right now. And I look at Tesla, and I don't understand why you'd have to be cutting prices if demand is as strong as they say it is. Is there any risk, Ron, in your opinion, that we're overstating how strong consumer demand really is for EVs?
Yeah, at least in the U.S., I think that is probably a fair characterization. I think what we've seen this year with Tesla's price cuts, give or take, the Model Y entry level is roughly 30% cheaper than it was at this time last year. And I think a lot of that is attributable to buyer preference. We've done a lot of work on the TAM of buyers. It tends to be very central. I mean, it tends to be very coastal in terms of who the buyer is, and it tends to be very affluent. So I think the benefit of the Inflation Reduction Act tax credits hasn't been as much as analysts would have thought this time last year. But no, I think that's a fair characterization that we think of pickup truck buyers, they tend to be more loyal to the brands. And I think what we've seen so far, at least with the early entrance into the EV pickup market, there's been a strong preference for the gasoline powered options.
And Ron, what do you think would change that or motivate more demand for the EVs? Is that going to be a function of building out the infrastructure? What are the variables, the factors?
Yeah, I think economics matter here always. So the starting price points for electric pickups are quite a bit higher than the starting price points for gasoline pickups today. And to really realize the benefits of an electrified pickup, it's over the life. But right now, purchase price and, more importantly, interest costs, so that monthly payment number, are really prohibitive for a large portion of buyers in the U.S. So I think it's a mix of time, macro, and then also like proliferation of technology bringing down costs ultimately, because it is prohibitive for the average buyer today.
So Craig, let's bring it back then to the ecosystem that is being developed around these vehicles as well, right? Not just the ecosystem today, but the ecosystem that's receiving a lot of investment right now, including from the U.S. government. Do you think that the sort of charging system that's being built out in this country is too big for what's expected in terms of EV adoption?
No, I mean, I think that there's room actually over the next few years for incremental funding in the space. I think it would make a lot of sense. What we're going to see and the tension that we're seeing in Detroit right now is strikes because the EV industry is going to change the future versus what combustion engines have been doing. So, the labor content is going to be different, and that's something that Detroit will have to adjust to. So infrastructure is a very, very important part of adoption. The automotive industry in this country has been heavily subsidized for decades. at different times through things like TARP and other mechanisms. Frankly, to build the EV charging infrastructure out there, we probably need another $10-20 billion on top of the $7.5 that's been set aside. But there's bright spots, right? You can actually drive coast to coast. EVs are, a good option in most areas of the country, and quite frankly, utilization is growing on the networks out there. So one of the stocks we're recommending investors look at closely is EVgo. We're bullish on EVgo right here. Why? Because even though inventories are climbing on the lots of the mainline auto dealers, many of them are seeing their EV inventories at 90 days or plus. EVgo is not seeing it, right? They're seeing actual charging rates on the networks become 10% of miles driven versus what they were at about 5% just a couple of years ago. And you compare that to Tesla drivers, 15% up there. So there's a discrete mix towards people charging, not in their home, not at their workplace, but to using fast chargers to go longer distances, drive their EVs more. I think the investment in infrastructure is the right thing to do because it drives jobs in America. And, it's not really that heavy compared to some of these other things that have happened out there.
So, Craig, why, and you talk about discrete drivers, why an EVgo versus, say, a Blink or one of the other charging networks? Does it have something that makes it more attractive?
So EVgo is just a good example. Another one that I actually really like is Electrify America. It's a piece of the Volkswagen Group. There were, press reports that it was going to be cleaved off as a SPAC IPO, that they were going to IPO it itself, and that they were looking to sell it for a number of years. I actually saw Dietz, former CEO of Volkswagen, kind of make a fool of himself in the booth at the LA Auto Show, not introducing himself to management there. But the bottom line is there are some very, very good assets out there. I prefer EVgo over the other things right now because they have very discrete drivers. I'm not saying that other companies are in bad shape. I think that there's a little bit of a pause on the DC fast charging infrastructure out there as people wait for the funding levels to come through. So 7 states have put through initial checks for NEVI funding. You have a lot of money that's waiting to be dispersed. There's about $5 billion that'll come through in those checks over the next few years. I just think it's kind of right time, right place for EVgo. Another one I can mention actually is the infrastructure bill. None of the money is being held up there. You look at Bluebird, right? This iconic school bus name. Revenue's up, deliveries up 20%, revenue's up 40%. Very large part of that is not just the price increases, but it's the mix towards EV sales. And EV sales are benefiting from, the vouchers, right? There was just under $1 billion last year. This year, we're going to get about $800 million in vouchers next month. President Biden's vision of, converting the school bus fleet to electric is taking shape. This money is not in question. And the orders are coming through. So the companies are executing, they're beating on the top line, beating on the margins. I expect Bluebird to behave well as a stock, as an equity, over the next several quarters. So, there are bright spots out there. You don't have to just look at, some of these vehicles that are expensive in the truck market and say that, I'd rather stick to gas or diesel.
And Ron, I want to get you back into here too and get your picks here. Since we got some from Craig, I'm curious what you like that is sort of EV adjacent.
Yeah, I think we cover the tier 1 suppliers as well as the manufacturers and the dealers. In the tier 1 suppliers, I think Aptiv is the best way to play electrification. It's global scale. They make electrical architecture, so you think of connectors and wiring, kind of the guts of the vehicle, as well as they have a pretty large ADAS and infotainment segment. But specific to electrification, their content on an electric vehicle is more than twice as high as their content on an ICE vehicle. They have business with almost every major electric vehicle manufacturer in the world. That includes Tesla, among others. And so you think about electric vehicle adoption, where it's stronger right now in Europe and China. Aptiv is a way to play that. It's a global name, global footprint. They generate more revenue and more growth from electric vehicle adoption in Europe and China today. But it's a name trading at a market multiple, growing above market 8 to 10 points. with strong expanding margins. It's very attractively valued relative to, I would say, most electrification assets.
All right, lots of good picks there for investors to think over there. Craig Irwin and Ron Yasufov, thank you so much.
Thank you.
And coming up, the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned.
Look at that. Speaking of cars, CarMax ringing the closing bell here on Wall Street on this Tuesday afternoon. Let's do a quick check of the markets here, get the closing figures for you. We've got stocks here, again, off the highs of the session. The Nasdaq, which was up as much as 1.2% or so today, finishing with a gain of about half that, up 0.6%. The S&P up about 0.5%. The Dow up about 135. That's good for a gain of about 0.4%. It looks like utilities ending up being the leading group today. Now, utilities, one of the sectors that has been hit as we have seen interest rates go higher, that is, Treasury yields go higher. With the big relief in the Treasury market today, the utilities getting some relief as well. That group up better than 1%. Consumer discretionary materials and staples also higher. In fact, the only group it looks like that's going to end the day in the red is going to be energy, as we see a bit of a pullback in oil prices. Well, in terms of stocks that we are watching on the day, a new report from The Information laying out how Netflix's advertising push may be proving tougher than the streaming giant expected. Shares of the company down by 3%, and they are trending on the Yahoo Finance platform. Now, The Information, which covers the tech industry, reporting here that there are some personnel changes at Netflix, that the ad sales chief, Jeremy Gorman, is being replaced with Amy Reinhard, who is a Netflix executive that's been there for a while. Josh, there's been sort of some waves here up and down of the expectations that people had for Netflix's ad-supported offering, but it felt like the latest wave was pretty positive.
Yeah. Interesting that folks reminding me actually that we've had some shuffles in that C-suite. Last week we named new executives take on the roles of chief product officer, chief technology officer. So there's been some movement there. Stock may not be, doing a whole lot today. You can actually see us down more than 3%, but it's been a nice performer this year.
Yeah, it has, in part on that optimism over this ad offering and what kind of incremental revenue they were going to get from that. So it's interesting here to have this, what it purports to be this sort of behind the scenes reporting from the information that maybe things there are not quite as solid as analysts had anticipated. But as you say, it's still up 62% over the past year. Not at all.
Shares of solar companies rising in today's trade. France announcing plans to boost solar power capacity in the country. And meanwhile, California regulators delay a decision to cut incentives for rooftop solar panels installations for apartments, schools, and farms. And you can see these moves here, Julie. Look at SunPower, First Solar, Sunrun Solar. Huge moves in the space. Yeah, huge moves, and it's a space that has been beat up recently, or at the very least has been volatile recently. SolarEdge in particular was catching my attention because it was one of the worst performers in the S&P 500 yesterday. It is domiciled in Israel, so it was swept up as well in the wave of stocks yesterday that were falling that had associations in that country as war breaks out there. But many of those stocks, I've been watching others, the likes of Mobileye, Fiverr, many of the Israeli-based stocks have been coming back today. Likewise, many of these solar stocks coming back today. That California decision is just delayed until early November. That might cut incentives for solar panels and solar installations in various areas. But nonetheless, the delay is enough to create some relief there in that group. All right. One to watch.
Yes, and also we're watching another one here, EA, Electronic Arts, Bank of America upgrading that stock to buy from neutral. And the firm seeing the risk balance of EA's rebrand of its FIFA franchise now appearing attractive. Are you a gaming guy? Do you get on?
I'm not a gaming guy. No? I'm not anti-gaming. Some of my best friends are gamers, but it's never found me interesting about this too. I remember we talked to Michael Pachter at Wedbush recently, and we're saying with the Microsoft Activision deal in the news so much, we did ask him, do you think like Electronic Arts or Take-Two could be next? And he said with all the regulatory challenges and headaches and drama, no chance.
Interesting.
Not on the target. He doesn't think so, no.
Well, I guess the folks over at Bank of America think so. They think that guidance will, quote, dispel investor skepticism over the sports franchise's ability to grow next year. So it looks like investors today, at least, are buying that thesis and buying the stock, which is up by nearly 3%.
Electronic Arts has a new friend in Bank of America. Nice to see. Teens are becoming more selective in their spending, which could be a boon for discount retailers. That's one to the takeaways from Piper Sandler's latest survey on teens and Gen Z retail trends. It found brands such as Chick-fil-A and Nike are teens' top picks. When it comes to food, footwear, and apparel, and Amazon is their #1 retailer for online shopping. Edward Yerma is a senior analyst and managing director at Piper Sandler and joins us now. So one stat here that interested me, Edward, was in your survey of teens, the self-reported spending is down 1% to about $2,300 compared to last fall. It's down about 4% from the spring. Why that decline, Edward? Did they explain, the teens, what storm clouds they were seeing here? Was it inflation, rising energy prices, student loan payments?
Look, that was a really interesting takeaway that we found as well. This is really the first time we've seen declines since COVID. On inflation, though, that actually is now #2 in terms of social and kind of news concerns that they have. So it's right behind the environment. 9% said that this was their primary concern, inflation, which has been ticking up. So we suspect that that's been a big driver of it. The other piece that's kind of interesting is that parent contribution actually went up as well. So it seems like these teens are having to rely a little bit more on their parents, and they're spending a little bit less than they had in the past.
Well, Edward, so that's interesting. A little bit more reliance on mom and dad. I get it. I was probably the same way. When you saw this decline, though, Edward, that you're mentioning, was there any kind of breakdown? I'm just interested in between males and females there.
Yeah, so females actually saw a more pronounced decline. Actually, males had a little bit of an increase. And so it really was the female consumer that was spending less. In particular, she was spending a lot less on apparel, which was down about 9% year over year. So, I think consumer, particularly the teen consumer, is just getting a little bit pickier.
You know, Ed, it's Julie here. It's great to see you, by the way. It's been a while. It's so interesting. We've got like the sort of cross today of your survey, as well as it being Amazon Prime Day again. And I've been reading a lot about the deep discounts, although we know that Amazon sort of plays the game of raising the prices so it can cut the prices. But all of it speaks to consumers' desire now to get a deal and that discounting is back. What does that tell us about the holiday season, whether it's teen spending or just American spending in general?
Look, the holidays are always promotional, but it looks like we may have an even more promotional holiday season this year, right? One of the interesting takeaways, the off-price retailers, so folks like TJ Maxx, actually saw a significant uptick in share. I think that dovetails really well with your point that the consumer wants a deal, they want great brands, and I think that's where they're really going to be focused on for holiday.
It's also interesting because in your survey, you took a look at the secondhand sites, right? Things like ThredUp, The RealReal, Etsy, which one would think could also benefit from the desire to save money, right? If you're trying to buy a luxury handbag, for example, on one of these platforms. And yet you didn't necessarily see that. What did the survey find on those names?
Yeah, it was interesting. On the e-commerce secondhand sites, we saw some weakness. If we look at kind of secondhand as a full category, so including physical stores, it was about flat. So it feels like this category took some share over the past couple of years, and share has been kind of stagnant. You know, part of us speculates that because the deals are so strong, either in the traditional channels or the off-price channels, that maybe it makes that secondhand just a little bit less appealing than maybe a couple quarters ago where promotions weren't as strong.
And Edward, one stat in your report that stood out to me were these stats you gave on the beauty sector, that teens spending $324 a year, Edward, on beauty, and that was up more than 20% from last year. What explains that jump, Edward, and where are they spending?
Yeah, my colleague that covers beauty has been bullish on the sector. I think, one of the things she cites is, really strengthening cosmetics. There's been a lot of innovation there. Obviously we're in a cycle where people want to look good, they're going out more. And so that this beauty category is probably proven to be a lot more resilient than things like apparel, where I think she bought a lot of clothes over the past couple quarters and doesn't need to, right? Versus beauty, where obviously as a consumable, you're going to be in market for that all the time.
And even though you don't cover makeup specifically, of course, some of the companies you cover sell it, right? When you look at, say, the mass retailers, the discussion, I feel like, around the likes of a Walmart or Target as of late has been a lot around grocery and apparel and less around cosmetics. Is that something that is still sort of a consistent driver for them?
No, I think Target's a great example, right? Target has been adding Ulta shop-in-shops, and they've been very clear that they've been successful there. Walmart obviously has been leaning heavily on grocery, but I think that the broader narrative is that these stores need kind of repeat traffic drivers. It's going to come in, week out. Obviously, food fits the bill perfectly for that. But some of the off-pricers have even cited beauty as a consumable. So I think beauty can be part of that equation. It's something you consume, you use up, and you got to come back and get more of. Whatever retailers can do to drive traffic to physical stores, I think is going to be really important over the next couple quarters.
Hey, Ed, while we have you, I'm going to take a little bit of a left turn. Don't be scared. It's something I'm sure you've been paying attention to. I mentioned, since you cover the mass retailers, we heard that commentary from Walmart last week that they were maybe starting to see an effect from the GLP-1s in terms of their demand. Then we heard from Pepsi today. I know you don't cover it, but Pepsi seeming to indicate it's not yet seeing a knock-on effect. As somebody who covers these retailers, how are you thinking about this issue, and how do you sort of even begin to quantify it at this point?
Well, it's interesting because they both can be right? I think when Walmart's talking about it, they're looking specifically at the baskets of people that are on GLP-1 and people that they believe that are on GLP-1 for weight loss, right? So you're talking about taking, hundreds of millions of customers per week and getting it to a small number. What the number is, we don't know, but it is a very small subset. And I think when you look at that subset, they are seeing some different behaviors, right? More fresh food, less sugary foods, less alcohol, things like that. But I think if you look at it from an aggregate level, top down, right, Walmart's not really selling any less cookies, any less sugary soda, anything like that. So I think, kind of what we're all thinking about is, as GLP-1 becomes a bigger and bigger factor, is this sample set a good indicator of where the business may go, right? We don't know that yet, but I think that's kind of how you could square what are seemingly divergent comments.
Ed, good to see you. Eddie Ruma from Piper Sandler. Nice to catch up. Have a great one.
You as well.
Coming up, bank earnings kick off on Friday. Are you ready? We're going to get you a sneak peek into how the sector performed in the third quarter. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Republicans on Capitol Hill gearing up for a debate tonight and eventual vote to replace Kevin McCarthy as House Speaker. And it comes as a critical time as President Biden called on Congress to approve aid for Israel and the possible threat of another government shutdown, of course, coming next month. Joining us now is Steph Kite, Axios politics reporter. Steph, it's hard to keep track, but the latest headlines I'm seeing are saying that Kevin McCarthy, who had said he might put his hat back in the ring, is saying, nope, never mind, I'm not doing that. So what's the current status here of this fight for Speaker?
Right. Well, coming out of last night's meeting with Republicans, which essentially turned into a 2-hour vent session, much of it targeted towards the 8 Republicans responsible for ousting McCarthy. But during that meeting, there were a handful of members who said that they were only going to vote for McCarthy, despite the fact that the former speaker had said initially that he does not consider himself a candidate, that he was, not going to be seeking that position again. And again today, he signaled that he does not wish for his colleagues to put his name in the hat this time around, which means this is going to be a debate tonight really between, Jim Jordan and Steve Scalise.
And Steph, in that run for speakership, Scalise and Jordan, who looks like they have pole position right now?
Well, the truth of the matter is both seem very far from the votes that they are going to need to get through the House right now. And there is still ongoing debate among Republicans over whether they want to change the threshold required within the Republican caucus in order to name their nominee. There are some who are pushing for Republicans, either of these candidates, to prove that they can get 217 Republicans on their side before they even go to that House vote. This is, of course, to try to avoid what we saw in January when McCarthy had to go through 15 rounds of votes just to get the speakership. And so not only are there debates between whether Republicans would rather see Majority Leader Steve Scalise or House Judiciary Chairman Jim Jordan, there are still ongoing debates over what those rules will be and how they will decide on which one will be the nominee, with people very concerned that this could drag out for the long haul, as many Republicans have not expressed their allegiance to either of those candidates at this point.
So if neither can get that support tonight and the rules aren't changed, then they set another date and debate again and vote again, and then they do it over and over again, I guess, until something changes?
At this point, there is a tentative vote that will be scheduled for tomorrow, so there is still a chance that they vote as usual, and whichever candidate comes out with the majority of Republicans voting for them is the ultimate nominee. But at this point, there still does seem to be so much up in the air. And of course, both candidates have different offerings to this Republican base. Of course, Jim Jordan is, presenting himself as the person who is able to get support from some of these further right members who have historically, at least this Congress, caused issues and were really the driving force behind McCarthy's ouster. Meanwhile, Scalise is someone who has been in leadership, who has experience overseeing an entire Republican caucus, has more of that backing, but maybe would be seen more as that mainstream and not far enough right for some of these handful of Republicans who, again, have continued to cause headaches this Congress.
And Steph, so without a speaker and given this sort of confusion here, how much tougher is it going to be therefore to get some important funding through? For example, calls for Israel funding, for example.
This is going to be a huge issue, obviously, watching the devastation that we've seen in Israel over the past several days. Both, members of Congress and the White House are concerned that some of this chaos in the House will make it difficult for the U.S. to provide the aid necessary to Israel. This has added a layer of urgency. We've been hearing from House Republicans who say that they see what's going on in Israel as another sign that they need to get their act together. They need a speaker. They need to be ready to support our allies. So this is really just raising the stakes even more. And we know that the White House has had discussions internally expressing concern that this speaker situation could hamper their ability to assist Israel. So we will have to see, there is potentially an opportunity for Republicans in the House, for the House to still pass measures to assist Israel, even without, a permanent speaker, but that could be difficult. And we have seen the House work slow significantly since McCarthy's ouster.
And I guess, Steph, that brings me back to Kevin McCarthy, because the thinking around him coming back maybe to run for speaker again was that he could be a figure who would unite the party and get through the necessary aid for Israel, for example. So when he says, don't put me in there, do we believe him? Is that his final answer, so to speak?
I think that's a good question and something that we're watching closely, whether, if his name is actually put out there, whether this is a position that he'd be willing to take again, if there is actually support behind him. But I do think it's significant that he has repeatedly said that he is not running, that he is not putting his name in the hat. And so he is at least continuing to say, look, you're going to have to choose between Jim Jordan, Steve Scalise, who are the two candidates at this point. But you never know if his name is put out there, if he would ultimately be willing to, again, lead this very fractured caucus.
Steph Kite, thank you for your time today. That was great. Appreciate it.
Thank you for having me.
And big bank earnings kicking off on Friday as big name players such as JP Morgan and Citi gear up to report their quarterly results. Let's get right to Yahoo Finance's David Hollerith with a preview on what investors can expect.
Yeah, so Josh, the outlook for banks has changed a lot sort of in the last few weeks of Q3. Deposit outflows don't really look as much of an issue as they were for Q2, but the Federal Reserve's signal to keep interest rates higher for longer is obviously going to pressure banking profitability going forward. And this is sort of a time for banks to come out and show investors that they can hang with a higher for longer environment. And now I would also point out that given the rise in the 10 and 30-year bond yields, the unrealized losses that banks keep on their balance sheets are going to be worse this quarter. Taken together, obviously, bank stocks have widely underperformed the S&P year to date. And, there's going to be a big question here about whether or not this is sort of the bottom, so to speak. Three of the big four banks report Friday, and JP Morgan Chase is expected to sort of steal the show as being the lender that is best positioned to withstand higher rates for longer. It's the only one that's expected to show a jump in core revenue compared to last quarter. It's also supposed to outpace peers on the year ago period. Bank of America and then Charles Schwab and then Truist are among the larger banks that have higher unrealized losses. So they're going to be needing to sort of thread the needle here. Again, this has been framed by analysts as more of a stock performance issue than a liquidity issue like we saw in the spring. But investors are clearly very mindful of this. So we'll want to see what management says about that. And then I think just going forward on the bank credit side of things, which is sort of the looming issue, commercial real estate, I think that is not looking to be noticeably worse, although we are expecting to see most banks sort of take higher net charge-offs, meaning they're going to be marking down more loans as having borrowers that are unlikely to repay. So all that taken together, we're kind of at an inflection point where, we're kind of staring at the worst of what bank lending is looking like. And most is hinging on the forward outlook for the next couple of quarters. Results actually do not appear to be that bad, but again, it's going to hinge a lot on how banks are looking to the future.
Yeah, a lot to consider here as we come up against this quarter. It will really be interesting to see if it's the bottom for some of these banks in terms of performance around rates. David Hollerith, and if it's the bottom in rates for that matter. David Hollerith, appreciate it. Coming up, we're going to go around the horn with some of the top stories of the day, including a survey on what Gen Z cares about the most. We'll be right back.
Welcome back to Yahoo Finance Live. I'm Alexandra Canal, joined by Josh Schaefer, Supermanian. And guys, today we're talking teenagers, good old teens, because Piper Sandler is out with their biannual survey about what Gen Z, is looking at and caring about. And apparently Netflix no longer is at the top there, actually falling for the first time behind YouTube, dropping 200 basis points compared to 6 months ago. Now, of course, we're in this fragmented media environment. There's a lot of competition out there. YouTube has also been upping its game when it comes to some of the content plays. And I also thought of the password sharing crackdown, where, if you're a college student, you now have to pay for your own subscription. Yeah. Doesn't matter if you're still, using your parents' credit card at the bar, you still, at the end of the day, need your own subscription. So that's what came to mind for me.
To me, it just gets to a way that we've known for a while now, I think, how younger people consume content, and YouTube being a core piece of that. YouTube getting into shorts, being good with that, but also people watch podcasts on YouTube now. People watch comedy skits on YouTube. They watch their favorite creators on YouTube, and that is not something that Netflix really has. I mean, Netflix has gotten into comedy shows certainly more and gotten into things like that, but the streamers don't have that unique edge that YouTube has, which is, I'm gonna go into the search bar, Google style, type in my favorite person, and just watch a clip of them. And it's gonna be super quick hitting, it's gonna be 5 minutes, and then they're gonna feed me another thing that I want again after. YouTube is much more of a social media than Netflix is, so it's not shocked when you take a look at the stat of streaming being watched. It's the percentage of streaming people watch per day. It doesn't necessarily shock me that YouTube's higher.
Yeah, and the thing is, like, 2 points, right? So clearly Netflix and YouTube dominating the space for teens, right? Dominating, like you said, 29%, 20%, a slight sort of win there for YouTube. And I think YouTube is sort of, that's where it's at, right? And if you think about, like, how, like I said, the Google search type way of sort of modality of watching, I just saw that, read up that the advertising was up 4.4% last quarter, and that actually was down the last 3 quarters, which is surprising to me. I'm like, what's going on here? I'm not sure about that, but I'm not surprised that it's rebounded there. And that's where it's at. I think that's where all those ad dollars are going to go from linear TV, because they're not watching linear TV, right? That's not happening.
Well, and I talk about it a decent amount. I'm on the older end of Gen Z, right? And I experience some of these trends, I think, a little bit differently than some people. And when I was in college, I had never used YouTube on a TV. Used YouTube on a smart TV to just search something and watch. And I found more and more people in the dorm rooms over my years there were doing that. And it was
do that now.
Yeah, and it was something I had never quite experienced, but I think more young people are doing that. You are with a group of people and you use YouTube as something to watch rather than Netflix is a hard algorithm sometimes for group watching.
Yeah.
And just wanting to watch something, I think YouTube sort of fills a little bit of a void there.
Yeah, I'm a fan of YouTube. I even think just education-wise, I remember in college I would look at YouTube, use it when I was studying accounting, and there's some really great informationals on there, explainers, DIY. Yeah. So I'm a YouTube girl.
We'll have to see what YouTube can tell us about the Fed's path forward after this.
I'm sure there's explainers on there.
I want to focus on another part of the Piper Sandler survey, because one thing that always stands out to me, and you see this in the fall, in the spring, you see this year over year, is the consistent brands. The powerful brands. You know what brands are going to be at the top of this survey. Guess what teens' favorite brand was? I'm wearing them right now. Nike. Nike was their favorite retail brand, and guess what phones they use? They use iPhones. They use Apple. And I think that is the biggest takeaway I have from this Piper Sandler survey when you think about it from an investor perspective. We talk a lot about the potential consumer slowdown coming, what brands survive, what brands thrive. It is companies like a Nike or an Apple. That was the analyst takeaway from Nike earnings a couple weeks ago was, hey, guess what? Even if the slowdown does come, it's not going to be for Nike. It's going to be for other retail brands. But teens still love Nike. Teens still love Lululemon. They still love Apple.
I'm
using all 3 brands right now in full Gen Z form. I have an Apple iPhone. I'm wearing Lululemon pants and a shirt.
And we're streaming.
And I'm wearing Nike.
On YouTube.
Yes.
By the way. I was just going to say this makes sense to me. At a time when you're seeing inflation high, consumers pulling back across the board, what are you going to spend money on? The brands that people know and care about. You don't want to be a teenager texting your crush and you have a green bubble and not a blue bubble. You want to be
can't have a green.
Can't have a green. That's a major no-no. So you want to be in on what is in, essentially, and you're going to pay up for those types of products.
Got to say, New Balances rising up there, being Vans in the teen survey. Also, I want to talk about Apple real quick. You mentioned Apple. Check this out. 88% expect their next phone to be an iPhone. 87% actually own one right now. 34% have an Apple Watch. The overall market share of all Americans in the U.S. is 45%. 45% Android. That means their teens are doubling up on iPhone, on Apple. That's just simply remarkable. They're dominating the space there. And I got to say, if I'm Apple, it's Yahoo Finance. This is Yahoo Finance, right? If I'm an Apple shareholder, I'm happy about this.
Yeah.
And the other thing, Pross, I'd add to that too, that really stuck out to me about Apple too, and you think about the future of Apple and where they're trying to go, that services part, right? If you look at payments, top payment apps for teens, Apple Pay, 43% of teens saying they're using Apple Pay, significantly higher than Cash App, significantly higher than Venmo, et cetera. Look at all the major banks. Look at Zelle, which Pross probably uses, right in the middle there. And
I'm Venmo.
But Apple Pay, I think, has just become so synonymous, right, with the way we pay for things. You just tap your phone.
I would say it's not even just teenagers at this point. I'd be curious, actually, with the older generations.
People in the city, I feel like
Apple
it's a very big thing. You can use it on the subway.
I was a recent adopter to Apple Pay. I was the girl that like took out her credit card. But now that I've done it, I can't. It's the best
Allie's
thing
been paying in cash for the past
under the table.
Yeah.
No. But I think, to your point, Apple is just one of those brands that continues to dominate the space.
You know, kind of sticking with big brands, sticking with teens, and just Americans in general. It turns out people don't want their brands to sort of be taking on big political sort of stances. A new poll by Gallup and Bentley University finds that 41% of Americans say businesses in general should take stances on current events, down from 48% last year, with declines across the board, different ethnic groups, things like that. It turns out that some minority groups and some marginalized groups do like their brands to take stances on political issues, but it's not really the case for most people. What they do want, though, they want companies to make positive impacts on employees with fair wages, health care, and bridging the pay gap. So
that stuck out to me.
Yes.
Especially because we are in this moment where we're seeing labor strikes across the board in Hollywood, the auto strike, which I know you're covering closely. Fair wages, treat your employees well. At the end of the day, you're a business. Operate as efficiently as you can as a business. And that was a very big takeaway for me.
I mean, this just reaffirmed what we've seen with Bud Light, right?
Yeah.
This just was the Bud Light story in a poll, which is it's definitely interesting to see and sort of adds to the narrative. But it is exactly what played out with Bud Light. You had a group of people, I think, that were drinking Bud Light and would have just preferred, not necessarily that they took the opposite stance of what Bud Light did, but just that they didn't participate in the conversation. Like Bud Light, I think that's part of the lesson that came out of that, was not necessarily have an opinion or don't have an opinion or use certain people or don't use certain people. Just they wanted Bud Light to not participate in that, and they would have kept drinking it.
Right, and then conversely, look at Disney and DeSantis. DeSantis is the one that sort of came after Disney, and actually, you know what? People actually agree more with what Disney was saying than what Florida and DeSantis wanted, and that sort of blew up in his face, right? And now they're mired in some sort of lawsuit. Florida wants to drop it. Disney says, no, we're going to go to court on this. We're going to take you to court on this.
Yeah, but it's very split. I report on Disney all the time. I get a lot of angry emails to me talking about how Disney is woke and has completely changed the mission. So, as a company, we're in a space and time in our country where it's very divided. And as a brand, you want to appeal to everyone. And when you can't do that, it's that push and pull of when and how you wade into certain political issues.
Certainly an ongoing conversation and something we'll keep following, but that's going to do it for us over here today. You're going to have more Yahoo Finance Live and markets coverage on the other side.
Streaming.
Medicare is starting to negotiate the prices of 10 drugs as laid out in the Inflation Reduction Act. But there are a number of lawsuits now seeking to end these negotiations. Yahoo Finance's Anjali Kamlani spoke with former Health and Human Services Secretary Alex Azar about drug pricing. Here's what he had to say.
I said this a lot as secretary. One of my top 4 priorities was tackling drug prices. But I'm not a politician. I'm a business leader, a technocrat, a health economist type person. I approached it from somebody who really understands drug pricing, saying, where are the inefficiencies in the marketplace? Where do we not have accurate supply and demand pricing mechanisms that lead to effectively value-based payment? And can I fix that? And those were all the interventions that I proposed and tried to do. Were very targeted, almost a roadmap from the inside of someone who knew how drug pricing worked. What's going on right now, I describe it as a solution in search of a problem. And also, frankly, it's a bit of a insult to the English language to call what they're doing negotiation. Let's face it, the statute sets a statutory maximum price that can be paid by law. And then it says the secretary can, in his unilateral discretion, with no judicial review, look at like 5 or so factors and pick a price that they will pay. They can look also not just at actual same molecule substitutes in figuring out price, but therapeutic substitutes. So they could say that drug X, well, you could just use drug Y instead. And so we'll look at that, the price of that as a way. Well, there's no check on that, no scientific validation, no peer review, no process, no judicial review, and they will just pick a price. And you know what the drug company can do? Nothing. They don't get to negotiate. They actually can only come back and give new data on any of those assumptions that went into the secretary's model, but can't actually say, it's not haggle. It's not you say 100, I say 50, we end up at 75.
But they do have a bit of a back and forth, don't they?
No, there's not.
They have a offer counter offer.
No, it's not a counter offer. The only thing that a drug company is allowed to do under the way the Biden administration is implementing this is to go back and say, you said our R&D costs were X, they were X minus 20. You said the federal government put in this much money, they actually put in this much money.
So nitpicking more than an actual...
It's only allowing you to challenge the assumptions that went into the secretary's decision making. It's not, you say 100, I say 50, we end up compromising at 75. That's not it. And the sanction, of course, is get out of the Medicare and Medicaid programs entirely, which we may eventually see companies develop that we may move to a cash pay market eventually for drugs if they implement this as radically as they seem to be doing. But initially, they're just going to have to comply because it gets up to, I think it's it's a very weird penalty provision. It can get up to a 1,900% penalty provision for failure to comply and be in the model. So it's not negotiation. It's plain old price fixing. It's price setting without any judicial review. That's one of the bases for the challenges against it. And the worst thing of all, it's in a space where we don't really have a problem. Part D, drugs, it's actually probably the most value-based competitive part of our system. You have very powerful PBMs negotiating with very big drug companies for formulary status, and we on average get close to OECD levels of discounting in that program. So other powerful economic countries, we get about like those rates. It also does apply to Part B. Part B is, when I was secretary, that's the physician-administered drugs as opposed to Part D, the retail drugs.
Right.
Part B is one where I actually, as secretary, said, that is broken. We simply, pharma says, here's the price. We say, we'll pay you 106% of that, the provider. And I said, that is a problem. We should fix that. I had a solution, which was we called most favored nation status, basically saying, whatever deal you give anyone else, you have to give us, as a way to sort of, it wouldn't be that. What would end up is they'd stop giving sweetheart deals to Europe and we'd get an equalization, basically, of price. Maybe there are other ideas, but this is just plain out price fixing.
So what you're saying is that there needs to be a solution to the problems that exist. This is not one of them. Do you think that we need at least more attention on the commercial space too, where outside of Medicare, maybe the trickle-down effect that some are hoping will happen?
I mean, I don't know why we need government intervention in the commercial space. I mean, you've got, again, 3 PBMs control about 80% of the market, I think. So they're doing the negotiation. So you've got companies representing 60 million, 80 million patients up against drug companies. you're going to get pretty much competitive pricing on that.
Our thanks to former HHS Secretary Alex Azar. And coming up, the trial of SBF, the crypto king's ex-girlfriend, Caroline Ellison, testifying in court today. We're going to hear all the details from someone who was in the room. That's next.
Former Alameda Research CEO and former girlfriend of Sam Bankman-Fried, Caroline Ellison, has testified against him today. She told the court he had directed her to carry out crimes that allegedly took around $10 billion of customer money from the FTX exchange to be lent to Alameda Research. Joining us now, CoinDesk editor Danny Nelson, who just left court for the day. Danny, I was reading some of the colorful details coming out today, including that SBF allegedly told Caroline Ellison he was going to be president of the U.S. one day, but that probably less pertinent to the case. What did you hear in the courtroom today that stood out to you?
Yes, I don't think Sam's going to be a president anytime soon. But what really stood out to me was Caroline's talking the jury through and talking the whole court through all these intricate loans that Alameda had with FTX. Now, Alameda, of course, is the crypto hedge fund that was making all these trades, trying to make all this money. Allegedly, according to prosecutors and according to Caroline, who pled guilty to many crimes, it was doing it with customer funds, $10 billion that it took from FTX customers through a variety of means, including having strange banking arrangements and just plain old withdrawing as much capital as it could.
And Danny, what was sort of your take on her testimony today? Did you find her to be convincing, reliable? I heard there was some sort of awkward moments, for example, reports that it took her 30 seconds, for example, to recognize her ex-boyfriend.
Oh, yes. So that moment specifically, when she came into the courtroom, one of the things the prosecutors like to do with their star witnesses is, hey, look out into the courtroom. Can you see Sam? Point him out to us. And for a couple moments there, Caroline could not point out Sam. She was just looking all over the place. She could not do it. And, I have to say, the last time she saw Sam in person, he's lost a lot of weight since his time in the Bahamas, and also he has a pretty shifty prison haircut where the sides of his fro have been cut off. So she had a little bit of trouble there. But yes, to get to the I guess you would say awkwardness of the courtroom, we did hear a little bit about their relationship. Now, these two people were on again, off again, boyfriend, girlfriend, and that you can't really separate that dynamic from his role as CEO of FTX and her role as CEO of Alameda. It's just a power dynamic that really probably should have no place in the business world.
And as you said, Danny, what she talked about also goes squarely to the case that prosecutors are trying to make against Sam Bankman-Fried, that he knew exactly what he was doing. That's sort of been his defense. He didn't really know, but she made it pretty clear in her testimony, right, that he knew what he was doing and he knew that it wasn't legal or on the up and up or ethical or whatever you want to call it.
Yes, well, I would agree with you completely there. Now, we didn't get into whether or not they were saying to each other, is this legal? I don't know. But what certainly they were talking about was, where is the money coming from? And the money was coming from, according to Caroline's testimony, customer funds. And Sam knew this, and according to other witnesses that we've heard during this trial, Sam directed it. She knew it. She was, as she's pled guilty, was complicit in it. And that really is at the heart of this case, whether Sam and whether FTX and Alameda were taking these customer funds, and if that was something that they were allowed to do. Now, we haven't gotten to hear completely yet the defense make its case as to whether they were allowed to be doing this, but according to prosecutors and according to Caroline, they most certainly were not.
And Danny, what are the implications, you think, of this case for the broader crypto space? Are there implications? Some people have said, listen, it's a big headline, it's a big case, but ultimately it's old news. It's a guy who was billed as a visionary, and now he's in a jail cell. Do you agree with that, or do you think there are implications, there are ripple effects, or at the very least there are some lessons learned for the broader industry, Danny?
Well, there are certainly lessons learned, and there's a lot of, I guess you'd say, old news. Like, we're not learning brand new, huge details about what's going down, but we are getting very important little bits about how everything played out. And this is a little bit feeling like crypto itself is being on trial. Now, Sam, in part through the media's work, was held up as this golden boy during his time as the head of FTX. He was looked to as a visionary, as someone who really knew what was going on, and he obviously wasn't. In court today, Caroline was talking about how they really didn't even know how much money they had loaned out. One of the last pieces that we heard today was looking at this piece of evidence where she had written out the different loans that Alameda had taken from FTX. There was $1 billion of Bitcoin, $1 billion of another cryptocurrency, and then $10 billion USDC with a question mark next to it. They didn't even know how much money that they were borrowing because their books were not really that well. I wouldn't say the books were cooked, but no one was watching the kitchen.
Danny, what happens now? What's expected next at the trial?
This is really the star witness. We, the reporters that have been crowding here, I think I got here today at, 4:50 in the morning. We've been looking forward to Caroline's testimony as the highlight of the trial. It's a 6-week trial. This is only week 2. There's a whole lot to come. We don't know what's going to happen next, but I would expect that because just today we heard the very start of Caroline's testimony, all of tomorrow is probably going to be Caroline. And I'm most looking forward to the cross-examination, where the defense team attempts to discredit her, place blame on her, say, well, maybe there was something wrong, but it was Caroline's fault, not Sam's. And it's going to be spicy. So it's something to watch out for, to be sure.
We will be doing that. Thanks so much for your help of laying out what happened today, Danny Nelson. Appreciate it.
Thank you.
We've got some news on Birkenstock here now, reporting from a couple of sources that the initial public offering will be at $46 a share. The Wall Street Journal, now CNBC, citing that, even though we have not yet seen the filing or gotten more information on the pricing from the company. So $46 a share would be midway through. We're hearing $44 to $49 was the expected range, Josh. So it looks like here that this is what we could get. At the top of the range, that would have been a valuation of around $9.2 billion. So it's not quite at the top of the range, but still, it's a big valuation for a maker of shoes.
A maker of shoes. As you know, two pair at the Lipton household as we speak. We're fans. I would say, so the trickle sort of continues. We've had Arm, Instacart, Klaviyo. Now you get Birkenstock, a company that traces its history back centuries, right? And then acquired by private equity firm L. Catterton. It'll be very interesting. I mean, private equity is going to be watching this closely. Founders will be watching this closely. What kind of reception does it get? What's the appetite like?
What's the appetite like? And it's also interesting in the shoe universe, if you will. You're looking at, it'll be interesting to see how the valuation compares to athletic shoe giants like a Nike, like an Adidas, for example. The Wall Street Journal had a story earlier today highlighting the Boston, which is the sort of clog fashion one, not the one that
made
is
my move
the
for the
sandal.
Boston.
Yes.
Yeah,
Wow. You're just giving up now, huh? No, it's just kidding. But apparently the Boston is hot, and so that's one of the things that's behind the resurgence in the brand. So it's very interesting.
Well, listen, it's a well-known brand, right? It's well-known. Some of its peers, I mean, it'll be interesting who you think of as peers, but like Skechers, for example, it's performed well this year.
Oh, look, there's a teal pair of Bostons. All right.
All right, moving on. Here is what to watch on Wednesday. Tomorrow we'll be getting the latest PPI data. Look at inflation on the producer level. Economists expect prices to rise 0.3% in September from August. That would be a slowdown from the 0.7% gain in August. We're also going to get the minutes from the Federal Reserve's September meeting, which will provide further insight on the path for monetary policy. Comes as Fed officials, remember, indicating a dovish tone, partly triggered by rising yields on long-term U.S. Treasury bonds. Atlanta Fed President Raphael Bostic says rates are now high enough to lower inflation to 2%, and he says no need to raise rates anymore. And we're going to be watching the first trade for Birkenstock. The company is set to make its debut now on the New York Stock Exchange and to be listed under the ticker BIRK. Reports that company is pricing shares at $46 a piece, near the middle of the expected range, which was between $44 and $49.
Well, that does it for Josh and I and today's Yahoo Finance Live. Maybe you'll go home, slip into your pair of Boston clogs made by Birkenstock or whatever your comfortable shoe of choice is. Have a great night, everybody. We'll be back here tomorrow at 3 p.m. Eastern.